Here with me now is Laura Mattia. She's a certified financial planner. She joins me now to talk about smart money moves you should make even if you're a little nervous. Thank you so much for being here.
Thank you for having me.
I really want to start at the beginning because we were talking about investors. Can we start off first of all talking about who is an investor? Are you an investor if you can make ends meet? You have a job, you can pay your bills, and you have a little money left over after that.
Well, sure. I mean, and that's a great place to start, truly, because, we've been saying this for years, that you need to, first of all, live within your means, then get out of debt, then you start saving. And you should start saving regardless of whether you're in a bear market or a bull market, but you have to take care of those other things first.
So if you have a savings account, that means you can qualify as an investor.
Well, first you need to create a savings account that serves as an emergency fund and that serves for your short-term needs. Investing is really about long-term needs.
So if you're someone who just says, I have a computer, I'm going to look at the stock market, and I'm just going to play with it a while, you don't really qualify as an investor, and you ought to leave it alone, right?
Exactly.
Okay, now that we know who does qualify, can we start now talking about investors?
Sure.
And when you talk about the nervous investor, I mean, there are people out there who are just people who talk doom and gloom all the time, the optimist and the pessimist. Should they also not be doing the investing?
Well, so I think we really need to put 2008 into perspective, because really the stock market, the declines are a natural thing. It happens all the time. I think the 1990s actually started making people think that the market always goes up, and that's just not the case. Really, the stock market is for long-term investing.
Remember the words
long-term funds. And I'm talking 5-year, maybe really even 10-year funds you will not need, because you don't want to be selling into a bear market. That's a recipe for failure.
So what should we learn from Madoff and the housing crisis?
Well, there's actually a lot of things that we could learn from that. Probably, I think, though, the biggest learning is that people need to take responsibility for their own affairs, and they should really understand what they own, and they should understand what they sign. And if you don't understand it, don't go there. So even things like probably the average person should be in things like stocks, bonds, mutual funds, ETFs, things that are traded on a public exchange like the New York Stock Exchange, where you can go to the internet, you can go to the newspaper and retrieve the price, see what the performance is. If you can't go to the newspaper and see what actually is going on with your investment, then you really need to ask a lot of questions. And, I hate to sound corny, but this saying is just so apropos and so true. If it's too good to be true, it is. And it's, there's a reason why that's so popular.
So in a market where investors are leery about getting in and making investments again, what should be their action plan?
Well, the first thing that I think people are starting to realize is that they don't have an action plan, and that they need to create what we'd like to call a strategy. So a strategy really starts out with understanding what your personal goals are and the time horizons associated with those goals, understanding what your risk tolerance is and your risk capacity, and actually then looking at what you're willing to do, in fact, creating a strategy on when am I going to buy, when am I going to sell, what am I willing to invest in, what am I not going to invest in. And a matter of fact, take all that information and document it. Sign the document, put it aside, and then when things start happening, whether they're bad or good, the question isn't, oh darn, now what are we going to do? It's, oh, we're going to stick with the strategy. And, it's just amazing. The people that have a strategy, and really very important, the people that stick to the strategy, those are the people that don't make the bad money mistakes.
So let's talk about some things that we really have over the years learned something about, like CDs and some of the things that seem to be pretty safe.
Yeah, well, actually, I know CDs and also money markets are a big thing right now, and people are going to treasuries, which are unfortunately not giving much of a return, if anything.
But
they're pretty close to zero. Well, I mean, so safety is an interesting term, right? There are different kinds of...
Because people are buying a lot of safes, actually.
There are different kinds of risk in the market, and in investing. And the two largest risks are volatility, market risk, which is associated with long-term investments, and inflation risk or purchasing power risk, which is associated more with short-term, lesser investments like CDs, more money market equivalent type of products. Now, you have to balance both of those things, and that's why it's so important to understand what your goals and your time horizons are, because if in fact, take for example somebody that has a long-term horizon, 20, 30 years, inflation risk, purchasing power risk becomes very, very important. $1,000 that you have today at an inflation rate of 3%, which is really the standard inflation rate that we've been running over the past, since 1926, in 30 years, that money will be worth $412. So you can't possibly live the same standard of living if, in fact, you just put it in these very, very safe investments. That's why you need the interchange, the playoff between the two kinds of risk, where you have some short-term, you have some long-term, and you combine them.
So should someone in their 20s, 30s, 40s, 50s be investing differently?
Well, yeah, age is part of it, but it's also really objectives, because somebody that's in their 20s might actually be saving for a house that they want to buy in 4 years, and in which case the time horizon is shorter. But in general, we can rest assured that usually people in the 20s, 30s have a little bit longer of a time frame. They can be a little bit more aggressive than somebody in their 60s. But once again, somebody in their 60s, people come and they say, I'm ready to retire, I should go into all safe investments. Well, you could still live for another 30 years if it works out that way.
And nowadays that could go well into 100.
Absolutely.
Okay. Thank you so very much for joining us.
Sure, thank you for having me.
When we come back, if you're having problems with paying your bills, like a lot of people, or your credit card interest rate's been raised without notice, we'll tell you how you can take control of finances and your credit. That's coming up next on Real Talk.